Welcome back to the Global Reset on CNBC-TV18 Prime, the show that tracks the deep shifts shaping capital, strategy and global investment flows. Today we are looking at the global wealth through a very specific lens. Where is mobile high net worth capital going and why? In a world of sticky inflation, shifting interest rate expectations and of course increasing geopolitical fragmentation, wealthy investors are being forced to think not just about returns but about resilience, jurisdiction and optionality. Joining me to decode these shifts are two seasoned voices from the world of wealth management. Dr. Isaac Poole is the Global Chief Investment Officer at Oreana Private Wealth. He's got a background that spans central banking. He was working with the Australian Central Bank for a while, asset allocation and investment consulting. Isaac brings a rare macro meets markets perspective to portfolio strategy and H&I decision making. My other guest is Menon, who's a senior investment strategist at OCBC, Singapore's oldest bank, formed in 1932 and still a cornerstone of wealth and trust in Asia's financial capital. Vasu has spent decades advising affluent clients and institutional investors across asset classes and economic cycles. Together, we'll explore where globally mobile high net worth capital is heading now and whether the US remains the default allocation or is it losing ground? Which regions and asset classes are coming into favor and which are falling out? Isaac and Vasu, it's a pleasure to have you both on this edition of the Global Reset.
Thank you very much.
Thanks for having me.
Well, before we start our conversation today, I thought it would be a good idea to lay the context for our conversation today. I had a chat earlier this morning with Dr. Raghuram Rajan. He needs little by way of introduction. Dr. Rajan is one of the world's most respected economists. Currently, he's, of course, the Catherine Dusac Miller Distinguished Service Professor of Finance at the University of Chicago Booth School of Business. He, of course, also served as the 23rd Governor of the Reserve Bank of India here. Let's listen to what he had to tell me about implications of tariffs and whether markets are adequately pricing those risks in.
Well, I certainly think that what we need to have is more certainty on where the tariffs will land. Right now, we have, as you just said, an agreement to talk. But at the end of this talking, what happens? And talking takes a long time. So even while people are talking, are tariffs going to go back to the Liberation Day level on July 9th, 10th? For the rest of the world, is it going to go back to the Chinese levels on August 10th, 11th? I think the sense is certainly the level of tariffs that were announced in Liberation Day are probably untenable. And so they will have to be negotiated down. But where and when is the kind of uncertainty that harms business considerably also. So a lot of businesses waiting to see, are they going to keep the tariffs, at least while the talk is going on, at the 10% level for most of the world, or is it going to go back up? So some certainty on that would also be most welcome.
Dr. Rajan, when financial markets do well, it kind of papers over a lot of other stuff, some of the underlying issues, etc. And if you look at global, the big markets, they're all a few percentage points away from all-time highs. It's almost as if tariffs really will not hurt. I mean, they're pricing in little to no damage because of tariffs. What is your sense? Is it possible we actually, escape any consequences, or do you think it'll show up? Not now, but maybe a little later.
Well, there is something somewhat funny about financial markets that as far as policy goes, especially when policy is as unpredictable as in the current situation, it seems to almost be putting a probability of 1 based on the current environment persisting. So when the US raises tariffs on Europe, immediately markets react negatively. The moment there is a discussion of a pause, they react positively. So I don't think markets are really pricing outcomes effectively. They don't quite know, and they're putting a lot of weight on continuity right now.
Just one more question to finish that loop. Do you think the tariffs are being used by the Trump administration as threats to negotiate, or do you think they're very ideological about this? And, as someone said, President Trump, in all likelihood, will not, this is his last term. So it's not as if he's standing for re-election. So he wants to effect change and bring manufacturing jobs, American manufacturing jobs, back to the States. So
I think,
is this going to be a
yeah.
lasting theme throughout? Or do you think at some point, I mean, he's going to give in and then, watch the markets and the good stuff comes? What's your sense?
I think the tariffs are not going to go back to the old levels. I think there is some level which will stay, maybe the 10%, and certainly maybe more in certain areas like autos. And that's partly because of the ideological underpinnings of the current administration. They do believe the US has been unfairly treated by the rest of the world, but they also believe that tariffs can give the US a certain amount of sort of playing power. But I also think that right now, with the tax bill, the big, beautiful bill under consideration, tariffs also play a role in being a source of revenues. And the US desperately needs a source of revenues to justify the level of tax cuts that are coming in the bill. So, for all those reasons, plus the fact that I think it gives the US a lot of power because it's a big market for the rest of the world's goods, I think they're not going to go back to the old levels. The question is, are they going to be uniform across the board? Are they going to be especially high for certain countries that are disfavored? And what is the longer-term certainty about the levels that are reached? Could it be that the administration turns on a dime and starts elevating them again for a country that it doesn't like or that has antagonized it? So I think a lot is up in the air, but almost surely we're not going back to the 3% level that the US was happy with before. It will be a higher level of tariffs.
And will it be 10%? Will it be 15%? I mean, I think that is the question. And as Dr. Rajan said, a lot is up in the air. Well, as I said, I have Dr. Isaac Poole of Oreana Group joining us. Vasudev Menon of OCBC is with us as well. Isaac and Vasu, great to have both of you here. Both of you heard Dr. Rajan there laying the foundation of our conversation. Isaac, if I can ask you, I mean, what does this mean, in your opinion, for a high net worth, globally mobile capital? What has it been doing? Give us a state of play as things stand right now, and what's happening from here?
Yeah, I think if we cast our mind back before Liberation Day, actually, we were noticing quite a lot of high net worth investors who were looking to diversify away from America already. They could see that there were some concerns around the potential of tariffs. There had been this US exceptionalism story for some time, but that had resulted in a very significant concentration for a lot of investors in US equities in particular. So in the start of this year, there was already a move towards diversifying those portfolios, particularly looking for other global areas to get exposure to less growthy assets, so quality and value, particularly in Europe. But I think for those large, wealthy investors, after Liberation Day, those who were able to, and many of them could, very quickly looked to reallocate back to the US, not perhaps to their full allocation, but to take advantage of some of the valuation benefits that came from the sell-off.
So some of it went right back, and that was the right decision in hindsight, Isaac, right? I mean, I think the S&P is rallied 25% from the lows and sits pretty for the year. Vasu, what have you been noticing across the sort of clients you service? A lot of them come from the ASEAN region. Tell us.
Well, I think you sense a degree of caution, guarded optimism among some of the investors. I think, as Dr. Rajan highlighted earlier, the uncertainty about where this is headed. And as Isaac said, I mean, a lot of our clients have started looking away from the US towards other non-US markets. And you see some of them gravitating towards Europe, gravitating towards China, gravitating towards some markets in Asia, ex-Japan. The recognition that, US exceptionalism has taken a breather. We're not sure for how long, but the US dollar is weakened, US equities have weakened. US treasuries look suspect. And so money is gradually moving. They've not given up on the US altogether. They still believe at the back of their minds that US exceptionalism will come back sometime in the future. So, the move is taking place, but it's been a difficult move because the US has done exceptionally well. And many of these high net worth clients have significant exposure to the US. And as they see the story slowly being played out post-Liberation Day, the reality is sinking in and more money is slowly moving out to other asset classes, including equities in Europe and China. And also, to some extent, investment-grade fixed income securities. We've noticed that with our clients, a lot of high net worth clients are very keen about putting their money to work in terms of getting yield. Yield is quite important to many of these clients. And so fixed income has been a very important asset class for them. And they're watching the fixed income space very carefully, especially the rise in long-term bond yields. And our advice to them has been, to stick to the belly of the yield curve, maybe the 3 to 7 year tenor, because that's less susceptible to rates volatility.
Vasu and Isaac, that conversation with Dr. Rajan, right? Towards the end of that conversation, I asked him, what is the one big non-consensus call? I was speaking with him on the sidelines of the UBS conference, and I said, you're meeting all these people there, so you kind of get a sense of what is consensus. So I asked him, what is the one, if I were to ask you the one big non-consensus call you want to make? You know what he told me? He said, well, the consensus is US exceptionalism is fading. Maybe it won't. So I thought that was interesting. But, so both of you are saying money is sort of looking at other places like Europe. I think both of you mentioned Europe as well. But how much of this, Vasu, if you want to sort of first come in, how much of this is on the back of just purely, not the big stuff, not this exceptionalism fading, but just the fact that, interest rates in the US are high, valuations are very high compared to where they were during Trump 1.0. So it's just a hot market and money is finding cheaper stuff. What's your sense?
You're right. It's not just purely about US exceptionalism losing its mojo. Investors also starting to look elsewhere where the valuations are more attractive. And as you highlighted, the valuations for Europe are more attractive. MSCI Europe is trading at about 14, 15 times forward 12 months price to earnings ratio. Compare that with the US, which is about 21, 22 times. So clearly, there's a big gap in terms of a big difference in terms of valuation between Europe and the US. I think the other factors that also augur well for Europe, aside from the loss of US exceptionalism, has been the fact that the ECB is cutting rates. We think it's going to cut rates more in the second half of this year. I think that's going to continue, whereas the Fed, it looks uncertain for now. And of course, I think there's a paradigm shift in Europe. Given what Trump has done, clearly you're going to see fiscal expansion in Europe. Many governments there are, upping the ante as far as fiscal spending is concerned. They're breaking down old barriers, increasing the budget deficit as a percentage of GDP, allowing that to happen. Germany taking the lead, of course. And I think that has also resulted in a change in view towards Europe. So what Trump has done has got Europe to wake up, realize it's got to stand on its own 2 feet, support its economy in a more aggressive way through fiscal policy and perhaps through monetary policy. And, that makes Europe more attractive. Similarly for China. China is also expanding fiscal policy quite significantly and probably more to come. And China has got a strong balance sheet, unlike Europe. And that's the other reason as well why we think, China has potential, because so much of bad news has been baked into China. Yeah. That's one of our strong conviction calls. And we think that, again, the Chinese equity markets are trading at 11, 12 times PE ratio, significantly below global equities, significantly below US equities. Right. And so even before this loss of mojo in US exceptionalism, we've already seen money starting to look towards China first, and then Europe later, of course.
No, absolutely, and that point about Europe is well taken. I discussed European defense spending on this program yesterday, and I had somebody from Bank of America who told me that Europe spent about 450 billion euros on defense in 2024. If Trump has his way, that number will, in 2 years' time, be 900 billion euros. So there is a lot more spending all across, which perhaps is happening on defense and on other stuff as well. Isaac, I mean, in terms of exposure to Europe, for those who can, what's the best way? Is it an ETF? Is it a specific market? I mean, what's the best way to go about it?
I think you need to be very careful moving into an ETF in Europe. It's a relatively concentrated market itself, and there's a lot of smaller companies there that you perhaps don't really want to get a great deal of access or exposure to. More broadly, we like to look at companies that offer real quality in terms of balance sheets and management. I mean, you are getting value anyway when you get exposure to Europe, but the quality side is really critical in an economy like that. And it's important to remember that broadly across Europe, when you're buying into that market, and of course the market is not just a reflection of the economy, but it's a low growth economy, and we may see some pickup of growth over the next 5 years, but it will probably take 3 to 5 years for that growth to pick up in a structural sense. So you really don't want to just get exposure to the index if you're moving into Europe.
And I think, as some have pointed out, when you look at the German market, for example, the DAX, I think 70–80% of revenues of the companies which form that index come from outside of Germany, Isaac? So that's the other thing.
Yeah,
right?
that's right. And so buying the beta, buying the index, if you like, you probably will have done okay this year. And, there's been a lot of hot money and fast flows in there. But I think from a more medium-term perspective, you're going to want to be selective about your exposures.
Absolutely. Isaac and Vasu, stay with us. I'm going to take a quick commercial break here. Come right back and pick up on some of the points both of you have made. And also we'll talk about asset classes. What should one focus on from here? Stay with us. Welcome back. We are still in conversation with Vasudev Menon of OCBC and Isaac Poole of the Oreana Private Group. Gentlemen, great to have both of you here. Thanks for staying on. Isaac, if we can start with you now on asset allocation. I know it's different for different people, but what is really running at the front of the pack in terms of where there is maximum amount of interest?
It has changed over the last 6 months or so, and quite remarkably. If you cast your mind back, particularly for the high net worth investors, there had been a very significant push into private markets, and particularly into private equity. And this is probably a 5-year-long move. And what they're seeing now is recent vintages have not been as successful, and that's driven a little bit of concern and skepticism and a desire to perhaps move away from private equity, but remain in private markets. And the asset class that's really benefiting from that has been private credit. And we see that desire to allocate to private credit coming out of their fixed income sleeve, and that's been really driven by the desire for yield that a lot of these high net worth investors have. And they are being quite cautious around where they allocate. They're not just allocating blindly across all private credit. It's not just going straight into mezzanine debt or real estate. There is a desire to move across geographies and across private credit classes to get that access.
We often hear about risks in private credit and how things are looking a little bubbly, and are they mark to market, et cetera, et cetera. Are those risks overplayed, or are they underplayed?
They're important. Absolutely. Not all private credit is the same. And I think there will be a time where the recent entrants into this space could be found out. They perhaps don't have the experience of working out debt issues. They may not have managed these credits through a cycle, or they may just be participating in parts of the market that they are not as familiar with. So this is an area where we work extremely closely with our partners and our high net worth clients. We have good partnerships with groups that have been managing private credit for some time, because, of course, this asset class is a little more liquid than private equity, but it's less liquid than your treasuries and credits. And so the risk of getting it wrong is higher. and the work around selecting the right exposures, therefore, needs to be even more careful.
No, absolutely. Got that. Vasu, again, I mean, the question is, what's top of mind as far as allocation to different assets is concerned? What are you telling clients and what are you seeing out there?
Thank you for the question. And I agree, Isaac. I mean, we can see, greater interest towards alternative asset classes like private credit, private equity among our clients as well. But they have not completely given up on public assets. And so I'll focus a bit more on public assets since Isaac has focused quite a bit on, the alternative asset classes in the private markets. In terms of the public space, I think our asset allocation recommendations have been, we are overweight equities. I know there are strategists out there who will not agree with us, but nevertheless, we believe that investors should overweight equities, but not blindly overweight equities where we see the opportunities. And we've discussed this earlier in the show. We are actually quite positive on Europe. But again, I agree, Isaac, it's about being selective in terms of your exposure to Europe, and buying the index may not be enough. Eventually, it's about picking up the right stocks and sectors within Europe. We are positive on China. We think the Chinese equity markets are undervalued, and in the next 2 years, 3 years, it could do fairly well as China tries to reinvigorate its economy through fiscal policy and to some extent monetary policy as well. So the Chinese and Hong Kong markets are overweight in our asset allocation. We're overweight the Singapore equity markets as well. And I'm from Singapore and based in Singapore, and we're positive in the market because it offers you attractive dividend yield. It's a defensive market, and it's one of those markets where the US is probably going to impose the lowest tariff because the US enjoys a trade surplus with Singapore. Now, aside from equities, we have a quality bias towards fixed income. As I said earlier in the show, our clients do look at fixed income quite carefully, and many of them look at private credit as well. They are in some ways competing asset classes, but they do look at fixed income. And our recommendation is to our clients have been, to focus on quality, investment grade fixed income securities with a tenor of between 3 to 7 years, the belly of the yield curve, because that segment of the market is probably less prone to, rate volatility and the potential for long yields to rise in the coming years. We are very positive on gold. We think gold has potential to rise to $3,900 an ounce in the next 12 months. We've been positive on gold for a long time. From as low as $2,000 an ounce, we remain positive. We think there's more upside for gold. And so these are some of the asset allocation calls as far as the public markets are concerned. From our perspective, our basic message to our clients is that, yes, there's a lot of uncertainty, there's a lot of volatility, but what we've learned from the post-Liberation Day episode is that sharp pullbacks in the markets can offer opportunities. And there's no reason for investors to take complete shelter and be completely defensive. There are going to be opportunities, and for the investors who are nervous, we tell them, undertake a dollar cost averaging program, spread your risk over time, manage risk over time. But we tell our clients to stay invested. And our calls have been validated by the sharp rally in the markets from the bottom post-Liberation Day.
A lot of gold investors, investors here in India love gold. I mean, actually, everyone loves gold. 50% year. Isaac, any thoughts specifically on gold? You heard Vasu there.
Yeah, I mean, we have seen and enjoyed a really solid rally in gold, and we don't necessarily come out with a price prediction for gold. It doesn't easily fit into our models, but we've been working with our clients who have held gold positions to maintain that without necessarily adding to that position, and it continues to be a great diversifier for those portfolios that hold it. And it in the current level of uncertainty that we're seeing globally, with that likely to persist, there's a good chance that gold remains a really important part of a diversified portfolio.
An investor portfolio and central bank portfolios as well, as we've seen CBs around the world become big buyers of gold. Thank you very much. We're out of time, but I think it's a good exercise to do, and we'll do this again maybe in a couple of months' time to see what's really happening with regards to global mobile HNI capital. Isaac and Vasu, thank you for your sharp insights and global perspective from capital flows to asset class pivots. It's clear HNI strategy is evolving fast in a world that's anything but predictable. Well, that's it on this episode of the Global Reset. Thank you very much for watching. Stay tuned.
Thank you for watching CNBC TV 18 and do follow us on all our social media platforms for news, updates and more.